All right, so good morning, and you are welcome to part 2 of IFRS 16. And here in the part 2 of IFRS 16, the issues that we are going to be discussing are: one, we're going to look at separating components under IFRS 16. We're going to look at number 2, reassessment of the lease liability. Reassessment or recalculation of lease liability. Then we're going to also look at lessor accounting. Lessor accounting. And don't forget, unlike the lessee accounting, in the lessor accounting, we still go by the way it used to be in IAS 17, the olden one. So we're going to split into finance lease, and we're going to split also into operating lease and see how each of them will be recognized. All right, then what we'll be doing is, lastly, we'll be doing sale and lease back. Sale and lease back. All right, I have a glimpse of sale and lease back under the first part, the lecture part 1 of IFRS 16, but I taught it with the illustrative meaning of how you're going to go by it. But here we are looking at an advanced level, and so there will be a little tweak inside that one. So we're going to look at sale and lease back. All right. Okay, so that is that. And here we're going to focus on when the transfer is a sale, meaning that the transfer fulfilled the recognition criteria of IFRS 15, and where the transfer didn't fulfill the criteria of IFRS 15. So transfer is not a sale. All right, so that is what we're going to look at. And lastly, we will also understand when the proceeds that you receive from those transfers are below the fair value or above the fair value. All right, so you could see that when it comes to the level 3, which is the SBR or the corporate reporting, there are certain nitty-gritties we need to bring to play again. All right, so what we're going to do is that we're going to approach this thing one by one. So let's start with the separate component. Let's start with the separate component. Now, when we talk of separate component, what happens is that some of the contract, remember we said that a lease is a contract or part of a contract. All right, so what you understand is that there may be a contract that part of it has a lease, part of it does not belong to the lease. So there is a lease component and there is a non-lease component. All right, so that is that. So when that happens, if you see a question of such nature, what you're going to do is to just separate them. So you're going to do a separation of the lease component all right, from the non-lease component. Okay, then after that, you are good to go to carry on with how you treat the lease component as we've been doing, and how you treat the non-lease. As for the non-lease component, if it's an expense, then you just expense it, all right? So basically that is that. You're going to expense it through your cash. Yeah, that is that. All right, so you will do the distinction here. All right, so you allocate to the lease component and to the non-lease component by weighting. All right, you weight it. Okay. So that is basically what you do here. It looks simple, but I mean, a question would do. Let's just take a question and walk through that. So we have this question to look at. All right. So let's look at the way we carry out with question 6, all right, which is an SBR question. Okay, so it says that on January 2021, Switch entered into a contract to lease a crane for 3 years. The lessor agrees to maintain the crane. So even though Switch is leasing, the lessor is the one maintaining it. All right, which means that there's a part that you lease, there's a part you've not leased. All right, during the 3 years. All right. Now it says that the total contract cost is 180. So he's paid 60 for each year, with the payment commencing on 31st December 2021. Now you see, that is the problem. He pays 60,000. The question is not specific what the 60,000 is for. Is the 60,000 for the lease or it is for the maintenance? Because if the person is, so what happens is that it is a lease contract. You see, as you can see, it is a lease contract. All right, so you have leased the asset, so you have a right of use. But when it comes to the maintenance of the contract, it is the lessor who is still going to do that. And therefore, the payment, and he's not going to do it for free. You have to pay him. All right, so it's like I've given you my asset, but if you want anything to be done on the asset, come back to me. I will be the one to do it because it is my asset and I know the proper way of dealing with it. And so you will come to me. So I will do the repairs and the maintenance, then you will pay me. So the question is that this 60,000 payment that is happening, which one is that? Which one is that? So he says that Switch account for the non-lease component separately from the leases. All right, then if contracted separately, it has been determined that the standalone price of the lease is 160, sorry, and the standalone price of the maintenance is what? 40,000. And the Switch can borrow, so the incremental rate of borrowing by Switch is what? 5%. So the first thing we need to do is to try and separate the components of the payment. Because what do we do in lease? We need our right of use, we need the present value of the lease payment. This is the money they are going to pay for 5 years. And the question says that it is commencing at 31st December, and this lease started here. So it means this lease is what? Is in arrears. All right, so now we have to split. So the danger for you in the examination is to going ahead to use the 60,000 as your PV. That's the danger. All right, so what do? We are told that this thing has 2 components. So what we're going to do is to split the components. So that is the first thing that we need to go ahead and do. So let's do the allocation. And we said that the allocation is done by what? Weighting. So the lease component, then we have the non-lease component, which is the maintenance. How do we go about with the lease component? We are told that the standalone price of the lease is 160. So what we're going to do is to take 160,000 divided by the 2 put together, and don't make a mistake to go and use this. It's a trick. It looks as if that contract cost invariably is useless. So what we're going to do is to add 160,000 to 40,000, and that gives us what? 200,000. So that is how we weight it. All right, so that is how we weight it. All right, now that has been done. So the next thing for us to do is to go ahead and do for the non-lease components, which will also be 40,000 divided by the 200. Now I have my calculator here. So if I take 160,000 over 200, that gives me 0.8. All right, so that is what it gives me. So over 200 gives me 0.8. So it is trying to communicate to me the part of the 60,000. So if I'm now going to apply by the 60,000, apply this one to the 60,000 so that I can know the component of that. Then I multiply by the 60,000, which tells me that the lease component is 48,000. And if that is 48,000, then definitely this one is 12,000. So now I found my lease component. So I go on to do my lease as usual. So now initial measurement. I will need my right of use, and I will need the PV of my lease liability. Yes. Which one do you do first? The PV of the lease liability, obviously. So it means that year one, which will be 2021, the end of 2021, talk about 2022, 2023, because this lease is 3 years. I am paying 48,000, 48,000, 48,000 each year. So if I'm to PV it, the rate is 5%, which will be 1.05 raised to the power 1. And this one, 1 over 1.05 raised to the power 2. 1 point. Don't forget, this thing is in arrears. And you see, this is the initial measurement, the date we are standing to do the initial measurement. And the payment is 1 year in advance. So we PV it like that. All right. So let's go ahead and get the figures that we would need. So if I multiply this by 1 over, what that thing gives me is 45,714.28. So let's round it to nearest whole number. And if I do that, I'm going to realize this thing as 45,714. All right, so that is that. Then I do for the next one, which will give me 43,537. Then I do for the next one, it gives me 41,464. All right, so that is what I have. Then I go ahead to total. If I total all these things, so I have 45,714 plus 43,537 plus 41,464. And that gives me 130,715. So that is what I have. Now this is going to be the basis of my right of use. So my lease liability will be 130,715. Is there any other initial cost we incur? If those things are there, you go ahead and you add. All right. So now that is what we have. There is no any payment, no other initial cost, no dismantling cost, future dismantling cost, nothing. So obviously, if I want the subsequent measurement for this one, what is going to be is that I'll have to depreciate it. And if I'm depreciating it, I'm depreciating it over 3 years. All right, so depreciation will be 130,715 over 3 years, and that gave me 43,572, which means that my carrying amount for my subsequent measurement, if I deduct from the 130,715, that gives me like 87,143. So that is my subsequent measurement for that aspect. Then I do for this one, my lease table. We do 2 years, don't forget. So I have my year 2021 and year 2022. So I have my balance brought down, which is 130,715. What will be my finance cost? It is the use of the 5%. So if I do 130,715 multiplied by 0.05, that gives me 6,536 rounded. Then my payments, all right, 48,000. If it is not paid, that figure becomes a payable. All right, then I get my balance carried down. All right, so what do? I add this one to my 137,115, then I minus 48,000, and that is giving me 89,250 or 251 rounded. So if I have my 89, so these are the things that when we come to the reassessment, you check, because in the next year, which is 2022, probably new information might come to play and you will not have that. So here we have the same thing as what? 89,251. And what do we do? If I have this figure, I multiply by 0.05, and that gives me 63. Take away my 48,000. So this figure plus 89,251 minus 48,000. All right. So I have 40,571.3 or 714. All right. If you want to go ahead and see that your lease is correct, you can actually continue to the last year, which your answer should be 0 anyway. So if you have 4,5,714, all right, then you do 0.05 on that. What that is giving me is 2,286. Then I less my 48,000. You realize that if I just add that to my 45,714, it gives me exactly 48,000. So here will be 0. That is just to confirm. All right. But when we are doing our extract, what will happen? So in our extract, what goes into the P&L will now be the depreciation. Okay. So the depreciation we had 43,572. Then I have my finance cost also, which is 6,536. Don't forget, we are preparing the account for the year 2021. So that is that. Pick the figures. My SOFP will read my NCCA of the PPE. What did we get? What was that amount? 87,143. Then I have my NCL, which will be this figure, because this figure is split into two, and that is from our first lecture video. You have to split it into two. All right, so the part that will be my NCL will be the 45,714, and the difference between these two will be my CL. All right, so if I do 89,251 minus 45,714, then it means what is going to my CL will be 43,537. All right, so that is that. You are good to go. All right, but the key is that your ability to separate the components. Don't forget that the maintenance too is part of it. And the maintenance, the trick in here is also going to your P&L. The trick in there is that you need to understand that the maintenance component is what is 12,000. All right, so that is that, which means that your periodic payment of the 60,000, you have to recognize 12,000. All right, out of it. That's the present value of it. Okay, the present value of it. Because if you multiply 12,000 by 3 years, what is going to happen is that 12,000 by 3 years is actually 36. That is telling you that when we PV those ones too, that is what is going to happen. So the separated component of that, you will have a maintenance of what? 12,000. All right. Then what happened to the double entry? The double entry is that in my NCA, I have cash, which is going to reduce. All right. So I'll pay a cash. So cash will be reduced by 12,000. All right. So basically, that is what you go in there and do. All right. So that is that. Good. Let's move on to the second aspect of the objective we have for today, which is about reassessment of the lease liability. Okay, the reassessment of the lease liability. And the reassessment of the lease liability, I've actually captured it in the IAS 37 video and used the exam of November 2023 ICA paper to actually deal with that. So let's look at, let's go further. So reassessing the lease liability. Now, why did I treat that in IAS 37? Because IAS 37 is what? a liability of uncertain timing or amount. So it's also a liability. So wherever a word liability comes in, make sure you reference IAS 37. And in the IAS 37 video, I took time to show you how the amendments are affecting the various standards of IFRS 9, IFRS 15, IFRS 16, and IAS 8, IAS 10, all right? All those places that it affects, okay? So that is that, reassessing the lease liability. Now, what happens is that you are creating or you are PVing a liability. For example, what we did now, the liability was 48,000. So what if at the end of 2021, you now realize that your liability for the subsequent years to come is not 48,000? Are you still going to use 48,000 to do the PV for your subsequent measurement? Because as for the initial measurement, that is what you have. At that date, that is what you have. But subsequently, by the time got to an end, you realize that your 48,000 is not actually going to be 48,000. So if it was going to be increased to like 50,000, then it means you need to use the 50,000, because according to what do you call it, IAS 37, you have to use the best estimates, the best estimate. So you don't use the lower figures, you rather have to increase it. All right, so that is the key thing you need to understand. That is the key thing you need to understand. So what then happens? The lease liability must always be what? Recalculated when new information or changes happen. All right. So that is that. Lease liability must be recalculated in the event of changes, all right, to the lease payment. Because one of the things you learned in the initial measurement is that there is something called variable payment. All right. So if there has to be changes, there is a change in that, then your lease liability must be recalculated. All right. In case those lease payments have changed. All right. So that is that. And when you do that, you realize that the carrying amount of the liability is adjusted. Is adjusted. All right, so that is that. Now, what then happens? The corresponding entry of the adjustments which is the remeasurement effect. The remeasurement effect. All right, is posted against the asset right of use. So which means the CA will also be affected. Now, personally, I felt like, we should apply something like IAS 19, where we are seeing a remeasurement effect. So there's a remeasurement component. If you have a remeasurement component, it should go to your OCI. And so that figure would have been seated in the OCI. It could have made some consistency happen nicely, which means our balance sheet will still balance. Yes, because it is being added to your liability to increase it if in case it's an increase, and it is also added to your equity OCI, so the same figure exists. All right, but here we said we should add it to the CA. Okay, so which means it will increase the asset, and it will also increase. So I thought that there's a remeasurement component. Let's take it to the OCI. Right, but it won't match, because when you try that as a person, you realize that we are adding it to the OCI, we are also adding it to the liability, And therefore, you see that our balance sheet will not balance because it's an addition. If there have been addition, subtraction, it will negate itself. So perhaps the reason we are adding it to the right of use asset. All right. That is just by the way. All right. So now we go on to talk about you adding it to the carrying amount of the right of use. All right. So that is that. Now, the question is that if you are going to do this adjustment, we are going to recalculate it. Of course, we always need a discount factor. So should we go ahead and use the original discount factor we use? That is the question. But here, take note, according to IFRS 16, the discount factor in place will change if the lease term changes. All right, the lease term changes. And again, if the entity assesses the option to exercise the option to purchase the asset, the discount rate will also change. All right. So what I say here is that the discount factor is maintained. So you can maintain the old discount factor you used unless the lease term changes. And entity or there's reasonable certainty that the entity will, all right, exercise the option to purchase the asset. So entity has reasonable certainty at that stage to exercise the option of purchasing the asset. The more reason why we will affect the carrying amount. All right, because if the lease term changes, you use the old lease term to perhaps do the depreciation. All right, so that is the main reason why. Let's pick up a question to deal with this kind of issue. Of course, the one that came in November, I've been solving the IAS 37 video, so you can actually take a look at that. So let's look at a question here. And I'm going to use this one to deal with it. And these are the areas the examiner is interested in your corporate reporting. I think there is even a past question, this one, in December 2022. All right, that is also on such thing. Similar one. All right, very, very similar. So you can take time to look at that after we have dealt with the one that we are looking at. All right, so you could see that I keep telling you that the examiner, you see this at the commencement rate, it is 125. Then you see incremental borrowing rate. You see this one, implicit rate should be 12. Should have been 12%. And they said that it's not readily determinable. If it's not readily determinable, then we use the 14%. Then you see the CPI has been revised to 138. Look at the question that we are coming to do. So I keep telling you that if you get the opportunity to buy this book, you will be having familiar questions to be dealing with. Look at this. Don't you see the same thing commencing at 125, but instead of 138, they made it 140. And they just brought in certain things to a little bit confuse you. It's the same thing. So now let's look at these questions. Let's look at these questions. All right. So what do? We need to go in there. It says that King Fire enters into 4-year lease per property with an annual payment of 1 million payable at the beginning of each year. That means that the first one was also paid here. According to the lease contract, payment will increase every year on the basis of increase in consumer price index for preceding 12 months. Consumer price index now is 125. The interest rate implicit to the lease is not readily determinable. King's Fire's incremental borrowing rate is 5%. At the beginning of the second year, the lease increased to 145. The consumer price index increased to 140. All right, over there. Now, what are we going to do? Initial measurement. So he said that discuss how the transaction will be done on the first day of the contract, that is the initial measurement, and on the second day, the first day of the second year, so that is a subsequent one. All right. So that is that. Then we have the initial measurement. What do? We need to recognize right of use and lease liability. So what do? Right of use and PV of what? Lease liability. If you have to do this, and before you do this, you separate component, do. So you can have a question where the examiner can combine separating components with reassessment of the lease liability. Just take your time and break it down. All right. Take your time and break it down. Separate it, then continue with your PV. All right. Just be careful. You can combine it together. All right. So now, what are we supposed to do? So at the initial stage, we are not in the second year yet, so we can't consider anything from here. So what we know is that PV, lease liability, what do I tell you? Those ones yet to be paid. I don't include those ones that has already been paid. But if you want to include the one that has already been paid, i.e. this 1 million, then it means that you PV it at 1. But I don't do that, which tells me that from what I do, the lease liability yet to be paid will be 2022. Because the first one in 2021 has been paid. It is 4 years, therefore I'll need to do 2023, then I'll need to do 2024. Like I said, some tuition centers will bring the 2021, bring the 1 million that they paid, and PV it at 1. But I don't do that. All right, so that is that. So what do I do? For me, I have 1 million to pay this year. I have 1 million to pay this year and the 1 million to pay this year. So what is the rate? 1.1. All right, because it will be 1 year. So I have 1.05 raised to the power 2. And I have 1 over 1.05 raised to the power 3. Now, punching these things, and rounding them, I have this one at 0.595. That is in millions, okay? Then I have this one at 0.91. I have 0.86. So in total, what I have here is 2.72. All right, so that is that. Then I come to my right of use. What are the things that comes to the right of use? The lease liability, which is how much? 2.72. Then don't forget, here we add payment at commencement. So payment at commencement, which is 1 million. So it means total here is what? 3.72. So like I said, some tuition centers will bring the payment and commencement here 2021 and PV it at 1 and get the 1 million. So here will be 3.72. So when they come here, they don't bring it here again. But I mean, I use principle-based teaching. So it is what the principle says that I use. All right. So now that is that. That is what we have. Okay. Now, as at this year, 2022, we are preparing the account. We still don't have any information, all right, concerning our 2021. So we are preparing 2021. So now, what do? What then will happen is that we need to go in here and depreciate. So depreciation, 3.72 over 4 years, right? So if I have 3.72 over 4 years, 3.72 4 years, it gives me 0.93. All right, which tells me that at this stage, my carrying amount is equal to, if I minus it from 3.72, I have 2.79. That is my carrying amount. Then my lease liability. All right, we always need the balance brought down. So we are standing here in 2021. We will need 2022. All right. Then balance brought down. Balance brought down is 2.72. Then payment, this is in advance. So you see, this is the trick. So the payment in advance, I'll put dash here. Because you see, you can also do it 3.72 and minus the 1 million. At the end of the day, you have your subtotal of what? 2.72. That's it. Then I calculate my interest. So those that bring the payment here are those people who will add that same payment at the top there and come and deduct back. So I have my finance cost, which is at 5%. All right, so 2.72 that I have, multiplying by 0.05. And please here, be careful. If the thing is 6 months, just do 6 months of it. All right, so that is that. So I've rounded it and I have my balance carried down. Deducting it, adding this one to the 2.72 gives me 2.86. So that is what I have. Now, normally when you stand in this time, you must do 2022. Now, that is where the issue comes, because at 2022, the liability is not the same as your balance carried down, and even at the beginning of it. Because right at the beginning of it, you realize that the price index has changed. It has increased. The price index has increased. So this is what will happen. So what will happen is that we need to go in there and change the price index. So that is what will happen. So because our 2022 balance will not be like our 2021 balance. So balance brought down, which is the beginning of the year here, should actually stem from the closing of this one, which means that at the beginning of this thing, we need to even do the remeasurement. All right, it has changed. So that is what will happen. So now let's come and do the remeasurement, because things have changed. And as at 2022, the liability is no more 1 million. What is this? Because the thing at the consumer price have increased to what do we call it? 140. So what do we do? If at 1 million, the consumer price was equal to what was it? 125. Now consumer price is 140. What will be the figure here? What will be the figure there? All right, it will be more, and if more, let's divide. All right, so because I don't want to confuse you, I'll go by the traditional way we used to do things. All right, so that is what I do. So it means that I'll have 140 million, right? And I will divide it by 125. So that is what will happen. So 140 over 125. That gives me 1.12. So it means that our liability has moved from 1 million to 1.12 as at the beginning of 2022, the payments. So it means that from 2022, and this is at the beginning, don't forget, from 2022 and 2023, then what? 2024. So what will happen? Here should be 1.12. And please be careful. If we are going to PV, we're going to PV it at 1. Why? Why are we PVing the thing at 1? Because we are standing at the beginning of 2022. So that is that. And the payment is in advance. So it's not like in 2022, the payment will be at the end. It's in advance. So be very, very careful. All right. Then here will be the same 1.12, but here we will PV it over 1.1 over 1.05. They didn't change anything. Raised to the power 1. All right, raised to the power 1. Then we have 1.12, so 1 over 1.05 raised to the power what? 2. So you have to be very, very careful about that. Okay, so now what do I have? My liability now will be what? Here will be 1.12. That is what I'll have here. If I now do for this one, 1.1 over 1.105 multiplied by 1.12, that gives me, if I round it, it's 1.07. Then the next one too, if I now do that one too, I have 1.02. All right, so that is that. So if I now total everything here, 1.02 plus 1.07, that's 1.07 plus 1.12. My liability as at this time, it's giving me 3.21. 3.21. So you could see clearly what has happened. What has happened? What has happened is that I am expecting 2.86, but at this time, the liability that I have is what? 3.21. 3.21, which tells me that as far as we are concerned, the remeasured balance for this one, remeasured balance carried down is 3.21. So that is what has happened. And this year, what is going to happen? Instead of paying 1 million every year, I am paying what? 1.12. So if I less 1.12, I have 2.09. Then I do my 0.05 on that, multiply by 0.05. That gives me 0.10. That is what I have. Now, if I now add it to 2.09, what I get is 2.19. So that is what I have. Do we remeasure here too? No, because no new information has come to light. Now, what did we say? What we said was that this part, this remeasurement aspect, what is the difference? Is 3.21 minus 2.86. There's a difference of 0.35. Now, which means that as far as we are concerned, this is our liability. All right, that is our liability. And this 0.35 is what we said that you adjust it to your right of use. Do you remember? All right, so that is that. So you're going to adjust it to your right of use, which means that this right of use we have, we need to add 0.35, all right, to it. That is the entries, all right. So what do? Which tells us that in our SPL, in the extract, we have SPL, you have depreciation. And how much was our depreciation? The depreciation was 0.93. We also have finance cost. What is our finance cost for that year? Where are you? 0.14. So we have that 0.14. 0.14. These are all P&L items inside what we are doing. Now, what then happens? What happens is that we go in there to do our SOFP. All right. So inside the SOFP, what is going to happen? What is going to happen is that we are going to record CA. The CA, how much is now our CA? We're going to record 2.79 plus 0.35. 2.79 plus 0.35. So what is that? 2.79. 2.79. So that gives me 3.14. All right, that is going to happen. Then we come to our NCL. Our NCL, what is our NCL? We pick the one in the second year. That is 2.19. Oh no, this is advance. Okay, in advance we pick subtotal. Yeah, 2.09. Then the difference of that and what we have. So what was that? The difference of this and what we have here. So that one will give me, so NCL is, don't forget NCL is 2.09. All right. The difference, I've told you in advance, is always equal to this for your CL, but you have to prove it by taking the difference, okay? So do the difference. All right, and this is coming from our first lecture in video 1. So go back to that, you realize why we are doing this. So it's 2.09 NCL, then CL will be 1.12. All right, so ladies and gentlemen, this is how you do what you do when there is remeasurement. And of course, I had this video, I had this question inside the book, and they faced it in November. So, I mean, if you take your time, if you learn what we've been teaching you and how these processes are even in the book, and you watch your lecture video, you will certainly make it in your corporate reporting. All right, so that is that. So that helps us to deal with the remeasurement aspect. Okay, so like I told you, there is a past question here you can take your time to look at on this one. It's the same thing, CPI. So they said that it's a 6-year lease. So that is what you need to use as your exercise at home. All right, and the lease payment is 5.5 commencing from, so this one is commencing from December 2020, which makes it what? Arrears. All right, the lease liability, yeah, baseline payment of 1 million included in the, it's expected, he said that the lease agreement specified that the lease payment, except yearly baseline payment of 1 million included in the 5.5, would increase. So I told you that they can increase, they can combine lease components and some non-lease component inside. Separate it. Separate it. Do well to separate it. Okay, so I've told you that. Do well to really separate those things. It's very, very important. So, because if you don't separate all those things, you realize that you have challenges with your initial measurement. All right. If in case you have to separate anything, then separate it. But as at the initial measurement, as you are doing that thing, I mean, you have to go by this 5.5. But if you are doing the remeasurement, they said that which will not suffer. It says that the lease agreement specifies that the lease payment, except this one, would increase. So that part will not increase. That part will not increase. So it's just trying to play with your mindset. So please spend time and go through that. All right. Increase on the basis of increase. So even though it means that the part that will be increasing will just be 4.5, not the entire 5.5, right? That is what they are trying to say, except the yearly baseline. All right, that is included. Okay, so that is that. Then the CPI, the commencement date is 125. So if the CPI was 125 and you use for your initial measurement, you see in some points that the CPI increased. I think we saw that. What was the CPI? 138. So from 125 to 138. So it should help you calculate the change. Implicit rate is 12%, but since it's not readily determinable, you will use the 14%. These are tricks to test your understanding of the standard. And I like these kind of questions. All right. It shows that you really understand what you are about. All right. So basically, that is that. Anyway, we move on to achieve our objective number 3 to talk about the lessor accounting or the lessor accounting. So let's talk about lessor accounting. Lessor accounting. All right. Now, in the lessor accounting, it's not like the way we do the lessee accounting. Lessor accounting differs a little, all right? So you have to be very careful, because in the lessee accounting, what we do is that there is no operating lease, finance lease. All we are known to is that we should recognize a right of use, all right? So that is what we do in the lease liability. Now, in the lessor accounting, so in the lessee accounting is what I described. So in the lessor accounting, what you do is actually break it down. Is it a finance lease or is it operating lease? So here we do that. All right. So the lessor, according to IFRS 16, the lessor must classify the lease, its lease, into finance lease or operating lease. So that is what IFRS 16 tells the lessor to do. Now, what is a finance lease and what is operating lease? Because your understanding about that will help you determine whether the question in front of you is a finance lease or it is operating lease. Okay. Now, this is what we do. What is a finance lease? In the finance lease, the risk and reward of the leased asset, that is the underlying asset, is substantially transferred to the lessee. Is transferred to the lessee. All right. So if you see that everything has been transferred to the lessee, then it means that it is a finance lease. Now, operating lease is the one that does not meet the definition of a finance lease. All right. Operating lease, therefore, is the one that does not meet the definition of a finance lease. I think I have my pen freezing. I think it's because of the internet. So I would wish to. All right. So we said that under the finance lease, what happens is that the risk and reward of the underlying assets are transferred to the lessee. All right, so that is what happens. Okay. Now, in the other side, so here we said that the risk and reward of the asset is substantially, the word is substantially transferred. It means most part of it is transferred to the lessee. All right, then we have here is a lease that does not meet the definition of finance lease. So if it is not a finance lease, then it is what? Operating lease. All right. Now, how will you know it is a finance lease? Of course, we've said the risk and reward are transferred, but we need to learn how to classify. You need to learn how to classify. How do you go ahead to appreciate how to classify it? You see that if it is if it is finance lease, then one or more of what I'm coming to say applies. One or more. Number one, we've already said, like ownership is transferred to the lessee. Ownership of the asset is transferred to the lessee. at the end of the lease. Now, if you are a lessee and you know that the ownership will be transferred to you, that is where you have to be careful, because if you know from right the initial stage that the ownership of the asset will be transferred to you, then it means that the useful life of the depreciation will be the useful life of the asset, not the lower of the lease term and the useful life of the asset, because you know that indefinitely you are going to have the asset, all right, or definitely you are going to have the asset. So that is that. Or the lease term forms major part of the useful life of the asset. Lease term forms major part. So if it is like that, then it is a finance lease. Forms what? Major parts of the leased asset. All right, that is that. All right, or even at the initial stage, when you do the PV of your liability, it is performs substantial part of the fair value of the asset. So if at inception, the present value of the liability, which also is the value that goes to the right of use, all right, is the amount is almost equal or substantial to almost equal. So this word can be, you can say substantial, all right, to the fair value of the assets, of the leased asset. Then it means that you are looking at a finance lease, all right. Another thing that you can also see is that the lessee can use the asset without any major modification. He won't spend much on it. He can use the asset as it is. Lessee can use the asset without major modification. And even if there is a modification, you realize that the maintenance and everything, that is the maintenance being the risk, is done by the lessee himself. So it means you've transferred it to the lessee. All right. So that is that. All right. That is that. Again, you can also add when the gain or loss on the fair value fluctuation falls to the lessee on fair value fluctuations, that is like impairment, goes to what? The lessee. That is the risk, another risk. All right. The lessee is bearing. Okay. Then again, you can also find out if after the primary lease term, the lessee will continue to use the asset or buy the asset at a lower than the market value, or i.e., the lessee can buy the asset after the lease term at a scrap. All right, at a scrap. All right, a scrap or a value that is lower than the uh, the fair value. Okay, so that is that. That is that. If you see any of these, more than one of these, then it means that the thing is a finance lease. All right. So that is that. That is that. Now, if it is a finance lease, if it is operating lease, how do you do the accounting? How do we do the accounting? So let's see how we do the accounting aspect. So here we have what? Finance lease and what? The operating lease. Don't forget, we are doing this thing in the books of the lessor. All right. It is never in the books of the lessee, because in the lessee, we've gone through that. So here, our focus is on the lessor accounting. All right. So please be careful about that. Don't confuse the two. All right. Now, if it is finance lease, then it means that the asset kind of is transferred. It's like you've sold it in disguise. So it is this one, it is the mere opposite of lessee accounting. It's the mere opposite of that. What do you mean? You remember in that one, what do? You recognize the liability, and you also recognize the right of use, which is an asset. Is that not it? But here, what you are going to do is that at the initial measurement, what you're going to do is instead of the lease liability, you are going to recognize what? A receivable. All right. So the asset is treated. That's all. That's all. So you treat it as a receivable. That's all you do, because what has happened? What has happened is that you have given the asset out, all right, and the person is using it. The person is entirely using it. So what is going to happen is that you have to treat it as what? Receivable. All right, because at the end of the day, it is in the hope that probably it may come or it may not even come. So that is that. So you see that the lessee has treated the thing as an asset. Okay, in him, he has treated it as an asset, and the lessee will have a liability. That liability to you is a receivable. So in this case, what we are trying to mean is that the opposite of the finance lease is lessee accounting. So that is it. So once the person has recognized an asset and has a liability, what do you have? You will have the receivable instead of the liability. So that is that. That is basically what is going to happen. All right. So what about the subsequent measurement? What about the subsequent measurement? Of course, the subsequent measurement, you do the lease table. And instead of finance cost, you replace it with finance income. Instead of payment, you replace it with a lease payment that you are, a lease receipt that you are after. So basically, that is that. All right. That is that. So let's draft it. So initial measurement is this. All right. Then subsequent measurement, what are you going to do? Subsequent measurement, you do your amortization table. The same thing you do. It's just that here you have a receivable brought down. You have, instead of finance cost. So it depends whether it's in arrears or it's in advance. So if it is in arrears, instead of finance cost, you have what? Finance income. All right. Then instead of payments, you have receipts. Then you have your balance, receivable, carry down. So that is what you have. That is what you have. The same thing. So NCA difference CA. All right. This one is going to your SPL. So basically, that is what you do. So it's not that really difficult. So everything is the same. Everything is the same. So at the inception, you are going to do present value. So this one, you do the present value, like the way we've been doing initial. But just that when you get the final figure, the value you get is not a lease payable. It is what? A lease receivable. So the same thing you do the present value. All right. So that is what you do. All right. So then you record it as a receivable. So basically, that is that. So subsequently, you come and do this. And when you do that, I mean, what do you have? If you have If it is in arrears, you know what to do. If it is in advance, you know how to. So it's the same, basically the same, all right? But when it is operating lease, okay, what do you do when it is operating lease? We will pick up some questions and we will do. So let's even look at this question. All right, so let's look at this illustration. So Vincent leases a machine to Tom. The lease is 4 years at a cost of what? Annual cost of 2,000, payable annually in arrears. The present value of the lease payment is 5710. The implicit rate is this. So since they've done the present value of the lease payment, what do? It means our initial measurement, since the present value has been done already, this figure is the receivable amount. All right, so you record it in the receivable. So this is the Vincent will recognize net investment in the lease as what? A receivable. So the investment that you have there is what? A receivable. All right. So that is that. This is the present value of the lease payment. It has been done. In other case where you have to do the PV yourself, you do the PV yourself. All right. So that is that. Okay. Then the receivable is increased by finance cost and is reduced by what? Cash payment, like I've said. So this is it. You started with this. All right. What is the implicit? This is it. 15%. You deduct. So like that. So you see at the end of the day is 0. All right. So it means in this year, what is our finance NCL? This will be our NCL. The difference between this and this will be our, it's not like NCL, NCA. All right. So this is it. Then the difference will be what? CA. All right. So that is that. So that is what you have here. Basically, that is that. All right. That is it. So this is what you have in your NCA. Then this one you have here is your finance income. All right. So basically, that is that. All right. So let's go to the finance lease, the operating lease aspect. The operating lease, what do? You recognize here what will happen is that it means that it is like the old accounting we do, that is like you just renting out the thing. So if you have rented out the thing, it means that you are going to recognize income. So you recognize income from operating lease on a straight line basis. So you just divide the income, the total income over the useful life, all right, okay, of the lease term, using the lease term. So your useful life is the lease term. All right, so that is that. That is that. If there is any other cost, those are added to the cost of negotiating the lease. All right, so basically that is that. So that one too, you have this illustration. So that one is quite easy. So I said that the lessor will recognize income from the operating lease on a straight line over the lease term. Any other cost here? So here you still have the asset belongs to you, the lessor. So you will have the asset in your book. It's just that you will be recording the returns, all right, as an income. On the finance lease, you won't have the asset in your book because the asset is already recorded in the lessee's book. So the only thing that you have is the receivable amount. Okay, so that is that. So any other direct cost is added to the cost of negotiating the lease. The underlying asset should be depreciated in accordance with IAS 16, or if it is impairment, then in accordance with IAS 38. Now watch this. Orbit hires industrial plant on long-term operating lease. On January 1, 2011, it entered into a 7-year lease on a mobile crane. The term of the lease are 175,000 payable on what? So this is every year, the beginning of every year, because this is the date it started. They will pay so initially they will pay 175,000, followed by 70,000 payable from 2012 to 2017. The crane will be returned to orbit. All right. The crane will be returned to orbit. Then on 31st December, so it will be returned. Unlike the other one, you know that it may be given to the lessee. The crane originally cost 880 and has 25 years useful life with no residual value. So you are going to maintain this in your books, and your normal depreciation will happen. So that is what will happen. So you are going to maintain it 880 in your books. Your normal depreciation will happen. However, there is a rental income. So the first year of the rental income, what is going to happen? This is what you have. You will take the 175. Then after that, you are going to take 70,000 every year. Okay, so that is that. And if you combine all those monies, you have this. And therefore, you divide it over the 7 years, and you have the amount that you'll be recognizing each year. All right, so basically that is that. In the statement of financial position, what you will have is that you will be having, what do we call it? Okay, let me correct this. In the statement of the financial position, you will be having what we call a deferred income, all right, each year. So you see the 175,000 that you have here, you have received 85,000, and therefore there is a 90,000 yet to be received. You recognize it as a deferred income, all right? So that is that. Basically, that is that. All right. So, but if they've paid it, there is no defer in it. But if they've not paid it, it's a deferred income. You just collect the one that you take. All right. So that basically that is that. Okay. So now, yes, lessor disclosures, finance, the things you do in the amortized table, that is what you disclose. All right. So that is that. Now, we are just about ending. Let's just take our sale and lease back, then work an example, then we are through. So how do we do sale and lease back? Of course, in the video one, I did sale and lease back in the perspective of, from the perspective of a financial reporting student to understand it. But let me just, now that you have a glimpse of it, let's just come back to the real deal. All right, so we look at sale and lease back. Sale and lease back. All right. Now, in the sale and lease back, what do you see? You have, let's say, party A, party B. So party A transfers the asset to party B. So party A transfers the asset. To party B, which means that in this case, party A is a seller and party B is a buyer. All right. Now, immediately he sells to him, he now leases it back. When he leases it back, all right, so if he leases it back, at that point, A has become what? A lessee, and B has become what? A lessor. So that is that. Now, if it is a lessee, a lessor relationship, we have to understand, did this sale meet IFRS 15? If it did not, we call it transfer. Is not a sale. It's not a sale. If the transfer is not a sale, then it means that what transfer are we talking about? We are talking about the fact that when he transferred this, it wasn't really a sale. He just gave it. So if the transfer is not a sale, then it means that A still has the asset. So A will continue to recognize the asset because he hasn't really what? Sold it. Okay. So what do we mean by that? We mean that if performance obligation has not been satisfied, there can be some sales, but performance obligation have not been satisfied. And please, this is IFRS 15. All right, so the sale must meet the recognition of IFRS what? 15. So you could see the examiner can combine two standards whenever he's questioning you on sale and lease back. You are the one who is supposed to tell the examiner that in this question, two standards what applies. All right. So you will continue to recognize that because IFRS 15 is not met. Recognition criteria is not met. Then what happens to the money that you then receive? So it means that, like we do in IFRS 15, the proceeds that you collected is treated as what? A liability. A liability. All right. If you are the lessor in that case, you cannot recognize an asset, the PPE. So what you have to, so here we say recognize a financial liability. All right. So here you do not, no recognition of PPE. But what do you do? Because the money is a loan here, you recognize what? The proceeds or money given. Money given is what? A receivable. All right. A receivable, which we call financial assets. All right. So basically, that is what that thing means. All right. That is what it means. But what if the transfer meets the definition of a sale, where you say that the transfer what is a sale? So you see, when we do it like this, apply the principle to the question. Transfer is a sale. If the transfer is a sale, then it means that at the initial stage you transferred, what is going to happen? You've sold it. So what is going to happen is that you will de-recognize the asset. De-recognize the asset. Do you remember disposal accounting? Disposal accounting in the lessee's books. All right. What about the lessor? The lessor has purchased an asset, so he will recognize a purchased asset. All right. A purchased asset. So that is that. That is that. What do we mean by de-recognizing something? It means that remove it from your books. All right. So what do? You have to debit. All right. So what do? Especially the cost, you credit the cost of the asset, or you can combine. So what you normally do is that you will debit the accumulated depreciation of the asset, and you will also debit the cost of the asset, or credit the cost of the asset. All right. But together, what can you do? You collected money too. All right. So what we normally say is that credit the cost of the cost to cost. All right, and debit what? Accumulated depreciation with all those accumulated. So at the end of the day, what we are saying is that you have a carrying amount of an asset. Remove the carrying amount of the asset. Remove the carrying amount of the asset. So that is that. You remove the carrying amount of asset. Now, when you debit this account, the corresponding account that you credit is what? The disposal account. And when you credit this one too, you debit what? The disposal account. So in effect, you realize that what you have basically done is that you have removed the carrying amount of the asset to what? The disposal account. You did this in PPE. So I'll reference you to go and watch the PPE video for more of that. This one has purchased an asset. So what will he do? He purchased an asset. So he will debit an asset. And the payment, did he pay by cash? If he paid by cash. All right, that is that. Okay, now, if he now leases it back, so you see here, what you do is that the sale is recognized. You see that we said carrying amount. So you de-recognize the asset and recognize the sale. All right, the sale is recognized at, please watch this, recognize sale at fair value. You recognize the sale at what? Fair value. So that is that, the fair value. Now watch this. Now that we have leased it back, the whole dynamism changes to the fact that this guy has given us an asset. So we will apply lessor accounting, what we just went through. So he will have to find out whether it was a finance lease or it was operating lease. Now, if it is a finance lease like we do, this one will recognize lease liability. Recognize lease liability. The PV of the lease payment, all right? The one we've just been doing now. Then you also recognize what? A right of use. Now, so unlike the first one I did in the video for an FR perspective, the right of use asset over here is recognized at a proportion, of the previous carrying amount of the asset, of the previous carrying amount of the asset. Please take note of this part. Of course, we will do an example, the same example I did in the what do we call it, the part 1 video. Then I'll bring you the tweaks here. All right, so that is that. Then what will happen? There will be gain or loss. So the gain or loss on disposal is transferred to the buyer. So please, is transferred to the buyer. Who? The buyer, or the buyer, to the buyer. All right, the one who bought the assets. So that is that. The gain or loss is transferred to the buyer. So let's go back and pick that same question and deal with it. Okay. So everything that I've said is here. So let's look at this question. The same question we did when I taught in the first video. Like I said, here you've grown, so that I've brought in this part. All right, so that is that. Okay, so how are we going to go about this? Let's see how we deal with this. So we have the question that reads, on January 2011, Akobeto sells a machine to Santo at its fair value of 3 million. Okay, then it says that the asset had a carrying amount of 1.2. Prior to the sale represents a satisfaction of a performance obligation, which means IFRS 15 is met. Okay, Akobeto enters into a contract for the right to use the asset for the next 5 years. So he sold, he's now leasing it back. Annual payment is 500,000 and are due at the end of each year, which means it is in arrears. Implicit rate is 10%. The present value of the annual lease payment you have here is 1.9 cedis. All right, so that is what we have. 1.9 cedis. All right. Now, it says that the remaining useful economic life is much greater than the lease term. Okay, so that is that. If the remaining useful is much greater than the lease term, what is going to happen? We will talk about that, because it makes us believe whether it's a finance lease or it's an operating lease. All right. Explain how the transaction will be accounted for on January 11 by both people. So here the attention is only on what? the attention is only on, what do we call it, initial measurement, when the entire thing will happen. All right, so what are we going to do? Obviously, we are talking about the transfer is a sale or the transfer is not a sale. And so therefore, what we're going to look at over here is to first do the selling part. All right, do the selling part. So it means that we are going to remove the carrying amount from our books, all right, and recognize a right of use like the way we do it. But don't forget, we said that the right of use, when we are recognizing, will be a proportion of the old carrying amount. And the gain or loss is transferred to the buyer. All right. Okay, so let's look at Acrobeto. In the books of Acrobeto. My pen. Okay. In the books of, oh, why is this thing shady like that? Acrobeto. Okay, in the books of Acrobeto, Acrobeto has sold. So what do? He sold for 3 million, right? We say recognize sale at what? Fair value. But we have to remove the thing too from our assets. Is that not it? Yeah, so basically that is it. So now, what do we do now? We would debit, of course, in the books of Acrobeto, he has received some money. He collected it from Santo. So we are going to debit how much? Bank. At this date, he received 3 million. Okay, so that is what is going to happen. Then, of course, we said that, first of all, since he has sold, so you could put this thing in the disposal account if you want, because the proceeds from disposal, all right, you could put it in the disposal. So when you debit your bank, what are you going to do? You credit your disposal account, all right? So this is our disposal account. So normally when we used to do the T account, what do? We have received money, we will debit. So what? We will credit what? The asset with the 3 million. That is our double entry. The carrying amount of the asset was 1.2. So what do? We will credit the carrying amount. All right. So you credit carrying amount, the machine, with 1.2. And we will debit here 1.2. All right. So this is what we do. We have removed the assets and we now have some kind of gain or loss inside this. All right. Well, how much is the gain? So we have a gain of like 1.8. That is what we have. That is what we have. So what do? For now, we have a gain. So this is the asset. And we have a gain of 1.8. We hold on to this gain. What do we do now? We continue with the right of use, okay, and the lease liability. We are going to make a payment, the lease liability payment, and here it says that he entered into this and is making an annual lease of 5,000 due at the end of each year. The present value of the annual lease payment has been given to us. So it means that, like I said, what do? We recognize a lease liability and a right of use. So we will debit ROU asset. But the ROU asset and the credit is the lease liability of 1.9. But the ROU asset, we said it is a proportionate of what? The previous carrying amount. All right, so the previous carrying amount, all the previous carrying amount is 1.2. So we will do the proportionate, which is we are having 1.9. Normally, this should have been it, but we are recording it as a proportionate. So it's 1.9 out of the fair value we collected multiplied by what? 1.2. So now, which means that what is going to happen is that I have 1.9 divided by 3 million multiplied by 1.2. And that is giving me 0.76. So what I will recognize here is 0.76. Be careful. Be careful about this part. Be very, very careful. All right. So this is what is going to happen at that date where we did the selling and we also lease back. The same thing, the same initial measurement, the same thing. So that is what is going to happen. So it makes us know that the difference of the gain or loss is going to be affected. Okay. So what do? We had a gain. We had a gain. So initially you realize that our gain was 1.8. That is what we had, our gain of 1.8. So that gain of 1.8 is going to be transferred, like we said, to the, in this case, it will be Santo. All right. So it's going to be transferred. So let's balance this equation. Let's balance the equation. So what do I have here? I have 3 million, a debit of my cash. I also have a right of use asset, which is a debit of this amount. So total will give me like 3.76, but this one will give me like 3. So I have 3.76. Then this one will give me like 3.1. Is that not it? So 3.1. So the corresponding, so I said credit or lease liability. The additional credit to make the whole thing balance. So if I have 3.1 and I'm minusing 3.76, that gives me 0.66, and that is the gain or loss. 0.66, so that here too will balance 3.76. So you will see that what has happened? What has happened we have here is that this is the gain or loss we are going to transfer. But you see that the total gain or loss was actually 1.8. That is what we have. So the overall gain or loss 1.8 is not going to be transferred. It's just, so the gain or loss is, what we are going to do is that in proportion to the overall 1.8 on the gain of the disposal will be transferred to college, because it is the same asset. Everything is revolving around the same asset. So what we are saying is that at this stage, you will transfer this to Santo. Not only is Santo only recording this, Santo also, what did he do? He purchased an asset. So in Santo's book, he will also debit an asset at the initial stage. You will debit an asset of what? 3 million, because he paid 3 million. And what will happen again? Santo will give out cash also of what? 3 million. That is that. Why? Why are we doing this? We are doing this because you see clearly that what kind of lease is this? The kind of lease here in Santo's book is what? Operating lease. If you realize, it says that the remaining useful economic life is much greater than the lease term. So we said that it will only be finance lease, okay, when the person, what does the person do? When the person transfers to the lessee a substantial part of the useful life of the asset. But here you realize that the greater part of it is being kept by the person. So what is going to do, therefore, is to recognize rental income. All right, rental income on a straight line basis, like the one we've described, on subsequent measurement basis. But at the day, the initial measurement, this is what happens. Of course, we recognize right of use irrespective of what the lessor will do, because the accounting for the lessee is always to recognize what? The right of use. All right, so that is the differences you need to understand from these perspectives. It's very, very important that you understand these things. All right, so apply the principle well, and that will be it for you. All right, so ladies and gentlemen, this is how we come up with transfer is a lease, transfer is not a lease. All right, so be very, very careful. So subsequently, this guy will record a rental income of how much. So you are going, this is the annual payment. You can add everything up, all right, and divide it by, but here you have the annual payment. Okay, so if it is an annual payment of, how many years are we leasing this thing? Is it going to happen? Five years. So the money is going to be multiplied by 5 years, and you spread it. All right, so that is that. As for the lessee, he has a right of use which he will continue to depreciate, and he will do for this side what we call the lease liability table, and this is in arrears. So basically that is that. He is going to make a payment of 0.5. So if we want to continue, for example, like this, you will pick your right of use asset, which is 0.76. You will depreciate it over 5 years. So what will happen? 0.76 divided by 5 years. That is 0.152. So 0.15 rounded, which means that if I now deduct it from my 76, my carrying amount therefore will be what? CA is 0.61. Then we will pick this one. Then we will create the lease liability table. So balance brought down will be 1.9. All right. You have listed finance cost is 10%. So which should be, so 1.9 multiplied by 0.10, 0.19. That is your finance cost. Your payment, you are paying 0.5 each year. Okay. So minus 0.5. All right. 0.5 here in terms of million. So that is what it is. All right. So in terms of million, that is what it is. Then you add the 1.9. So basically you have something balance carried down of like 1.59. Then you continue. I mean, that's that. All right. This guy will be recognizing you combine all the lease monies that he is taking and divide it over the 5 years, amortize it over the 5 years. So basically, that is that. All right. That is that. So I think we've achieved the objectives. Okay, so all these things are seen here. All right. Then the last part is what we learned, that the transfer at the fair value. Transfer at fair value. So what did we learn? All right. So we learned that in the event the lease payment or the sales revenue are not at fair value, IFRS 16 mandates that if the thing is below the fair value, then it is regarded as what? A prepayment. A prepayment, okay? A prepayment. But if the thing is above the fair value, then it means that what is going to happen is that we will treat that one as an extra funding. So let's just go through this illustration to end the class. All right, so look at the illustration we have here. So on January, we have Mohammed, who sells an asset to Cynthia, 3 million, the same thing. Its fair value was 2.8. So you see, he sold it at 3 million when the fair value was what? So it means he sold it over and above the fair value. And because this thing is kind of a related party transaction now, all right, so that is that. That is that. Then what happens is that the asset had a carrying amount of 1.2, like the one we did. Everything is just like the one we did. But you see, all that we are saying in addition to this is that they brought in the fair value of 2.8, which they sold. So this 0.2 will now be additional what? Financing. All right. The present value of the lease payment is 1.9, and it is assumed that 0.2 relates to additional what? Finding. Therefore, the remaining 1.7 is the one that is relating to what? The lease. So it's an additional information that the examiner can bring. So look out for it. Was it at below fair value or above fair value? If it is below fair value, then it means that there is an additional financing in this PV. All right, so you take it out. So you realize that it is when you take it out that you can now recognize the right of use. So your right of use won't be 1.9 anymore. It will be what? 1.7. Apart from that, every other thing holds. Every other thing holds. Of course, like we did, you have your cash. Then the right of use is also a proportion. All right. How did you do the first one? We proportionated it, so a proportion of the previous carrying amount. Okay, so here it will be, here will be 1.7. all right, it will be 1.7 instead of 1.9 over the 3 million. It will be 1.7 over the 2.8. So 1.7 here, 2.8. So you see that is how it's going to be. All right, so basically that is that. So of course, the gain or loss, the balance is this one. Everything is the same, except that if it is above the fair value, then it means that, what did we say? It means there is an additional financing component inside the lease. All right, the lease payment. So please take note of that. What if it is below the fair value? It means that if it is below the fair value, it means that there is a prepayment in the lease payment. All right, so that is that. There is a prepayment in the lease payment. Okay, so it means you have made an advance payment. All right, so basically that is that. All right, so be careful, watch out for these issues in your question, and thank you very much for the time. God bless you, and see you in any other lecture video. Of course, the number is here. You want to contact me for this manual, you can have yours. All right, especially when the new syllabus is at play. It's just that there will be a little tweak in price. Bye-bye.